Here's a statistic for you. Nearly $150 billion has flowed out of equity mutual funds over the past year. That according to the Investment Company Institute. And it's no wonder the retail investor has left the stock market. An entire generation of investors hasn't made money in stocks over the past 12 years. Add to that technical market malfunctions from the flash crash to Facebook's IPO and most recently Knight Capital's errant trades. So is market structure broken or is Wall Street rigged? And what can be done to shore up investor confidence? Here to weigh in is James Angel, Associate Professor at Georgetown University's McDonough School of Business, who specializes in the regulation and structure of financial markets and who is on leave at Wharton for the year. And Lee Munson, Founder and Chief Investment Officer of Portfolio LLC and author of the book, Rigged Money, Beating Wall Street at Its Own Game. Gentlemen, welcome to the program.
It's great to be here.
Professor Angel, let me start with you. We've had so many technological mishaps, and perhaps the most alarming was Knight Capital, given that it's got such a prominent role as a market maker. You know, there's a sense that systemic risk is built into market structure. Is market structure flawed, and are the markets unsafe?
I won't say the market structure is flawed, but I will say that we can improve some of the rough edges on it. Clearly, we need to do a better job of preventing problems, and we need to do a better job of containing the problems that are inevitable.
So, I mean, what's your take then on these new regulations, the so-called circuit breakers that the SEC has implemented after the aftermath of the flash crash? You know, is that enough? Do you think we need better regulations to police our markets? Is the structure still too far ahead of regulators?
Well, the circuit breakers were a step forward, but there's a lot that needs to be done. All the circuit breakers do is catch something after it's crashed. Instead, what we need are systems that look not only at price, but also at volume, at liquidity, and data integrity. If there are problems in any of those dimensions, we need to take corrective action. But I don't think anybody wants to go back to the days when middle-aged guys were yelling and screaming at each other on a wooden trading floor. So our system mostly works a lot better than it ever did before. Can it be improved? Certainly. Should it be improved? Yes. But we've got to be very careful how we do it. There are some people who go, ooh, high-speed computers, bad. Well, most of those high-speed computers are doing good things. But to the extent that people are using modern tools to do bad things, we need to be chasing bad guys and not just shutting down the entire market.
Lee, weigh in here. What's your take on market structure, these algorithms and high-speed trading? Do you think that high-speed trading should be banned?
Well, I don't think the going from the back, going backwards on those questions, I don't believe that high-speed trading should be banned. I think what investors need to know is that we've had a sea change over the past 10 years where in the old days, when I started coming on work on Wall Street, you had dedicated market makers. And what their job was to do on the New York Stock Exchange, and no different than even the NASDAQ electronic market system, is that you had people who would step in and buy and sell shares on the bid and ask all the time. What's happened, though, is that high-frequency traders have put a lot of those people out of business. And what's the issue with that? Well, during normal markets, I love the liquidity. I love getting all my shares executed in dark pools and all these things you hear about Wall Street being rigged. But when the rubber meets the road during a crisis, unlike dedicated market makers, unlike the old system, what we have are these high-frequency traders that simply leave the venue. And so what we have now are people who bring liquidity to the table when times are good, but when times are bad, they have no legal obligation to stick around for the cleanup. That's what's changed over the past few years, and that's why I think we need to have a change to the regulation of high-frequency traders. They need to stay when things get tough, and I think that at the heart of it is why investors should be cautious, and I think why a lot of them have lost their interest in the stock markets these days.
Professor Angel, how much of this advent of technology is a good thing? And does it come back to the fact that exchanges are now public? They're functioning to make a profit, and as a result, perhaps taking on more risks at the expense of investors to turn a profit for their shareholders. Right, look no farther than co-location.
Well, you raise a good question. Congress dictated to the SEC to come up with a competitive market system. And if you want competition, you have to give people an incentive to compete, and that means for-profit exchanges. So the SEC basically did what Congress told them to do. But Congress really did not overhaul the regulation of the exchanges, and that's where we need to rethink how we regulate our markets.
Lee, let's talk about returns. We've seen a massive exodus out of equity mutual funds on the part of the individual investor. Bill Gross has said he thinks the cult of equity is dead. Do you agree? Do you think that the stock market is one giant Ponzi scheme?
No, I think Bill Gross is a great salesman, no different than Warren Buffett. You know, I read his latest letter this week, and what he's really trying to say is that the returns of stock and bonds are dead. I don't believe that the longer-term return of equity is going to be as poor as it has been over the last 10 or 12 years. I do think that we could see inflation. I do think that there's a limit, obviously mathematically, to bond prices, you know, the yield going to zero. And I do think that most of the outflow of equity mutual funds, that is definitely a rigged figure. If you start to adjust for money flowing into international equities, a lot of those scary stats are themselves mitigated. So I think, if anything, I think Bill Gross is rigging the information that people are hearing.
That's an interesting point, but even so, even if you think that good times are ahead for stocks, you know, individual investors still feel burned. So how do we restore investor confidence, and what can investors do to, quote unquote, beat Wall Street at its own game?
Individual investors need to know one thing in order not to get scammed. The more my industry can convince them that the cult of equity is dead, that returns are going to be poor in the future, and that they should really maybe look to CD rates, the more profits there are for people like myself and my clients who actually invest. The bottom line is there are less potential profits going forward. Everybody participates like they did in the past. There's less profits. There's less of a pie to cut up.
That's an interesting point, but so how would you put your plan into action? Like, what specific steps would you offer individuals?
Well, number one, you do have to reduce what you think the market is going to do. I have clients all the time, or prospective clients, who say, you know, can you do 8%? Can you do 10%? And the answer most likely is going to be no. So I think that what you have to do is that, you know, when you go on these online financial retirement calculators, you know, the way to do financial planning is not to, you know, move the bar to a higher rate of return until you get to the point where you can retire. I think secondly, you have to look at a total return environment, not relative returns. And that means getting away from pie charts, getting away from a 60-40 mix, and really looking at where there's opportunity to make money. And I think you're going to have to rebalance a lot faster than quarterly or annually. The way people got screwed over the past 10 years is that risk expanded in the stock market, and their portfolios were not adjusted for it. So if risk doubles the stock market by way of the VIX or volatility, you should own half as much if you really want to remain a long-term investor.
Professor Angel, final word to you. What's the solution to get the small investor back into the market? How do we restore investor confidence?
We need to do several things. But what's going to drive investor confidence mainly is the underlying economy. When consumers think that the economy is in good shape, that we're returning to economic growth, and that there are going to be serious returns to investing, then they will invest. Clearly, the glitches do not instill confidence in the details of the market structure. And so we need to do a better we need to do a better job of containing the inevitable technological problems that will occur.
Gentlemen, great discussion. We'll go ahead and leave it there. Thanks so much to both of you for being with us.